Now, the Nigerian equities market was bearish last week as the all-share index lost 1.1% week-on-week to close at 33,257 points. This dragged year-to-date returns further down to minus 4%. Will the bearish sentiment continue this week? We ask Robert Omotunde, investment researcher at Afrinvest. Robert, it's great to have you on the show with us. So I guess, first of all, you could talk about, the activity we saw last week, largely negative. Were you surprised at all? And is that likely to continue this week?
Thank you for having me once again. It's not surprising what we saw last week. The market is currently at a level or a phase that we describe as being calm, given that we've not seen any possible major trigger from the current administration. And what we saw last week was just more or less a continuation of what we've always witnessed. You will recall that before last week, market gained for 2 weeks consecutively. So what we saw last week was more of short-term investors taking profit and market more or less normalizing. So what we are expecting for the week is the current trend is likely going to continue. However, we think that we are currently nearing the inflection point of the phase out of this current phase, given that we are expecting that the new government will begin to make certain pronouncements which will likely excite investors, to take position in this market.
And we've been talking about that all month, obviously, hopefully it's something that we're going to see come through because, we're obviously going towards the end of June now.
Yep.
So maybe that's something that, it will be a month since the inauguration, I think it's next week, Monday.
Yep. Several factors we, of course, determine what the direction of the market will be in the near term. Even if the current government does not come out to make any major pronouncement that will make the market move in some form of direction, we'd expect that the half-year earnings result will probably be the major determinant of direction of the market. But unfortunately, we are not so positive about the results to expect for the first half of the year, because that generally the macroeconomic environment has been very, very shaky. We would say that a lot of states are having issues with paying salaries. This will have impact on consumer spending, which in fact would have its impact on the general market.
When you say general market, then you say the earnings, you don't expect the earnings will be too good in H1.
Yep.
You mentioned consumer spending, that will obviously impact on maybe the consumer companies.
Yep.
Their numbers were not too good anyway.
Yep.
Their full year numbers and even their Q1 numbers in general were not so positive.
Yep.
But there were some areas where we saw good earnings. The some banking stocks had positive earnings come through. Are you saying that even in H1 that you're expecting, when you say the general market, will this impact on everyone, the banks as well?
No, why would we're expecting that for the consumer goods sector and of course the industrial goods, you are not likely to see major earnings that would be positive. Not necessarily that all the companies are going to report negative numbers, but we are saying that we are not expecting very fantastic numbers. For the banking sector as well, that the regulatory environment has been very tight, and with a number of regulations that are coming on board, and the pressure that the banks are facing, in terms of even growing their top line, we expect that this may also be a drag. Notwithstanding, you will still expect that some banks will be able to weather the storm and report.
When are some of those earnings going to come through? Because obviously, end of the half year ends on Tuesday.
Yep. But
a lot of analysts I've spoken to say they might actually take a month before we see the results. Yep. Is that correct?
Yeah, it's possible. Based on NSC rule, they have a maximum of a month to report their quarterly result. But we've seen in time past a number of banks and a number of other companies, in other sectors who have been able to return their numbers. Some will report, the second week of the new quarter, and it may not be unlikely to expect that even in this current period.
Now, you mentioned in your notes here that the Nigerian equities market is somewhat showing a cheaper pricing in comparison to, you know, the equities market in Kenya and South Africa. Talk about that.
Yeah, it's interesting to note that, of course, this has been the situation ever since the market has been going through this what we call dull moment. If you compare the pricing in Nigeria to other markets within the sub-Saharan Africa, you look at South Africa, which is trading at a 19 times PE, or a Kenyan market, which is trading at about 13 times PE, relative to Nigeria, that is trading at about 8 times PE, like 7.9 times. You know, you would see that relatively Nigeria is still cheap. But again, the various factors that we are experiencing is not the same. The macroeconomic conditions of Nigeria is not the same with what we are experiencing. I mean, the South African market is experiencing. We are aware that the oil prices are still down. You know, there are fiscal challenges that the government has to face. We have issues with shaky reserves and exchange rates. There are expectations that, you know, there might still be further devaluation, and all of these factors put together, you know, will make investors, you know, think less of Nigeria. But again, we are saying that given this pricing, for investors who want to take an advantage of the market, you know, in anticipation of clear-cut policy direction of the new government, Nigerian market may be a market, you know, to look
All right,
for.
Robert, let's leave it there. Thanks so much for sharing that. Robert Omotunde is an investment researcher at Afrinvest. Now,